Hello everybody, this is the ActivTrades weekly catch-up, where every Friday we look at the events dominating the news agenda. We focus on geopolitics and economics, keep an eye on the markets, and always look for trading ideas. Wednesday was the first day of open trading for shares of Deliveroo. After floating last week on the London Stock Exchange, the takeaway delivery services IPO was described by some observers as suboptimal, having failed to attract the attention of large institutional investors. What was supposed to be a headline-catching event ended up being disappointing, with demand rising to only one-third of the initially predicted. Shares ended the first day of trading priced at £2.80, giving the firm a market capitalization of £5.1 billion, which is well short of the expected £7.6 billion. Those responsible for the deal blamed choppy markets and short sellers for the disappointment. However, it has been pointed out that the timing of the floating was not the best, having missed the big tech surge of 2020. Also, some institutional investors mentioned labour disputes at Deliveroo as a reason not to invest at a time when businesses face greater scrutiny over such matters. The public offer, London's largest ever from the tech sector, was supposed to showcase the British capital as an attractive location for firms looking to become publicly listed. Competition is fierce right now, especially from other European exchanges like Amsterdam, and the underwhelming results of this IPO will certainly not enhance London's prospects. Also on Wednesday, the Federal Reserve Monetary Committee published the minutes of the March meeting. The most important point to take is that the central bank officials don't seem overly concerned about the possibility of inflation rising to dangerously high levels as the economy recovers. The Fed did hike its forecasts, with growth expected to accelerate and surpass previous expectations. However, there was no mention of any intention to start tapering the current asset purchase program of $120 billion a month or to raise interest rates anytime soon. While some officials voiced concerns over a possible escalation in consumer prices due to increases in demand, the committee's overriding statement was that during the last economic expansion, inflation remained low and that there aren't enough reasons to believe that this time round things would be different. The Fed's stance contrasts with the prevailing narrative in the financial markets, where it has been all about inflation. Many investors believe that colossal monetary and fiscal stimulus, together with the euphoria likely to occur in the post-crisis, will trigger high inflation. This is why, until recently, Treasury yields had been rising, with the dollar also gaining ground. However, it seems that investors may have started to believe more in the Fed's willingness to maintain its current dovish stance, overlooking any inflation fears. For this reason, this week we've seen the 10-year Treasury yield drop from 1.73% to 1.64%, while the dollar also lost ground in relation to other major currencies, despite the rebound on Friday that followed better than expected Chinese PMI figures. Looking ahead, over the next 7 days, we will keep an eye on the European retail sales figures, which are published on Monday. American inflation comes out on Tuesday and German inflation on Thursday. To close the week, we'll have the release of American retail sales numbers on Friday. Special attention to be paid to US inflation, as it is likely to have a strong impact on investor sentiment. This is all for today. I will be back next Friday with more views on current affairs and the financial markets. In the meantime, please go to ActivTrades.com for more market analysis. If you enjoyed this video, don't forget to subscribe to our channel and give us a like. Thank you very much for watching.